Welcome to the Dividend Talk podcast, episode 173 Dividend Investing with Leo Nelissen. Hey, everybody, welcome back to another episode of Dividend Talk. In this episode, we are joined by special guest Leo Nelissen, who is an author on Seeking Alpha, who will chat to us about his unique investing approach. We will talk about everything from macroeconomics to different sectors to energy and his own unique investing strategy. On top of that, we will look at some news of the week and we will answer some questions from the community. So sit back and relax, and we'll see you on the inside. Hey, European DJ. How are you today, buddy?
Actually, quite good. Come back, of course, from a long week of work. Had no time to do anything, but my portfolio kept nicely growing up right this week. That as far as I follow the market this week. But hey, I got actually someone reaching out to me on social media, Derek, because I'm making sometimes a fool of you by making sure you pronounce the names well, like Marcin last week. So I got quite some how is it feedback as well on my pronunciations in English. So the challenge to you next time is to call us a little bit more out, because we're making fun of your English as an Irish person. But I think sometimes the feedback was you should correct me as well.
Yeah, but I'm too polite for that. Look, we know Dutch directness. We know what you're like. I just, I just let it slide. So, I'm okay. I'm okay with that. It is quite hard, and I do apologize. It is quite hard to pronounce some of these European names, particularly with my slang. But I do my best.
Well, for
That's all we can
instance,
do.
I give you a nice one. I often say cyclical, but it's cyclical, and you never
Cyclical.
tell me that.
Yeah, of
You know,
course. But I think you pronounce your syllables and your vowels a little bit differently than we do.
yeah.
So I let that slide.
A pristine balance sheet instead of a
Pristine.
pristine
Yes,
balance.
yes.
So maybe
There's a
you're the smart ass here. You just let me look like a fool all the time.
there's a few I could pick up with, but hey, speaking of Dutch directness, I have two guys to contend with today. We have a guest on the show, Leo Nelson. Did I pronounce that
Yes,
right? I did. Okay,
Nelissen,
good.
yes. Yes.
We're off to a good start. Leo, for our listeners, you might give us a brief introduction, just about who you are, really.
Yeah, well, people on Twitter know me as @Leo Nelissen, which is my name. Um, I'm people may be familiar with my work on Seeking Alpha, where I share my investing ideas, macroeconomic outlooks, and similar. And I work with Brad Thomas on his company White Mode. I think people may be familiar with him. He also has a company called iRead, which is also on Seeking Alpha, where there's some overlap. So I work with him on various projects. I've also a background in advising high net worth clients and funds on geopolitics and macroeconomic issues. And yeah, as I said, on Seeking Alpha, I combine all of these things. And Twitter I use mainly to, I don't know, share my thoughts, post charts, just give people a look into my brain, so to speak. And yeah, that's how I know you guys. And I'm really happy to be on the show today. So thanks for having me.
Yeah, thanks for joining us. Now, I'm really excited for this. It's going to give us something a little bit different. We did actually have Brad on here maybe 6 or 7 weeks ago, but it's good to have another Seeking Alpha monster on this show. I just looking at some of your articles, you write some quality stuff. So I'm looking forward to picking that brain of yours and seeing what your journey has been like. But
Fantastic.
before that, we usually talk about some news of the week. Um, we have some news here, but as the guest, is there anything on your mind or that stuck out really in the news this week?
I mean, news-wise, I think most people were, at least in the US, were focused on Thanksgiving. Now people already think about the holiday. But I think some of the things that stood out to me is if you look at European and also US manufacturing PMIs, these leading indicators that tell us what companies expect in terms of manufacturing growth in this case. We also got Michigan consumer sentiment, which was down again. Another factor was, included in Michigan confidence, that people expect inflation to remain much higher actually than analysts expected. And although oil has come down, I still think that these issues are really something worth keeping an eye on going into next year. If it's pretty much a toxic mix of elevated, sticky inflation, a Fed that can't yet cut rates because it would probably ignite a second wave of inflation, and meanwhile a weakening economy. So I think this week, although we didn't get that many headlines, was pretty much not a clear statement of the economic risk that we are dealing with.
Yeah. And how do you look then when you see this news? What do you think then when we also know that the S&P 500, if you zoom out, is still, of course, let's say around all-time highs. How do you look at that?
Yeah, I would say in general, I mean, I think at the end of last year, I started to say, when it came to longer term predictions, that S&P 500 could, I think it's poised to be range bound and pretty wide range. I think mid 3,000 points to mid 4,000 points, which is, we are now at the upper bound of that range. Because if you look at the drivers of this rally, it's mainly, especially when you look at the impact on earnings, it's the Magnificent Seven, like Nvidia, Apple, Microsoft, you name it. And these companies are actually doing quite well. Even if you look into earnings estimates, these companies are just expected, at least most of them, to keep growing by double digits the next few years. And these companies obviously a very, very big part of the market. And then you have smaller companies. If you look at Russell 2000 companies, 40% of them lose money. So I think it's, I mean, most of people that I advise, they own just ETFs, S&P 500 ETFs. You're fine, and I wouldn't worry about it. Just I wouldn't try to time the market. But in terms of the risk reward, if you don't get a scenario very soon where just the growth allows, where growth rebounds and inflation comes down further, allowing the Fed to actually cut into strength, that would be utopia. But if you don't get a scenario like that, I think the risk reward for the S&P 500 at these levels is quite poor. I wouldn't say we are going to see 30 to 40% sell-off or anything like this. It's just, I'm very cautious at these levels and really careful when it comes to where do I put my money. I'm really looking for outliers in the market instead of just buying the market.
Yeah. Sometimes I get this feeling like maybe this is one of those decades again where we will look back and it will feel like a lost decade, like we had in the early 2000s.
I'm always thinking about this scenario like this. Actually, I have a pinned tweet on my Twitter which says, which it shows a picture from the Wall Street Journal. And usually when valuations are this elevated, you get, as you said, a prolonged period of subdued returns. And another risk is, what if inflation stays sticky, right? So let's say you buy just random growth stocks and the Fed keeps interest rates high, you get elevated inflation on a prolonged basis and weak economic growth. I mean, I think you could be looking at pretty poor returns for the next, maybe even 10 years. So that's something that I'm really looking for, to find beaten down outliers in certain areas that I trust in an event where returns could be pretty bad.
Okay. And do you feel the same then? Obviously, S&P 500 is US, but what about the European market? Is the sentiment similar over here?
Yeah, I think, I mean, I would be even pickier in Europe. I mean, some people know I'm based in Europe, but I don't have any European exposure at this moment. There are some stocks that I'm looking at an entry if they drop. But I mean, if you look, for example, in the Netherlands, the AEX index, it mainly consists of companies with international exposure. So, I mean, I wouldn't say it doesn't matter what our economy does, but it's pretty much international companies that focus on the global economy. And then you have Germany, obviously suffering from deindustrialization risk, elevated energy prices, structural issues. So I would be really, really careful in Germany as well. France is maybe in a better spot. The UK, pretty dependent on banking and commodities. So that's a market that I think is quite interesting. Now, I'm not a big fan of the big UK companies. I think there are better alternatives in finance and energy. But I think if you want to invest in Europe, the same goes, like the risk reward is somewhat poor, but overall earnings, valuations, I should say, valuations in Europe are much lower than in the US. So, but it has a reason. Obviously, we have structural issues with energy and supply chains and whatnot. But there are some opportunities in Europe. You just need to be really careful when you pick these companies.
Yeah. And speaking of Germany suffering, our news of the week this week, I don't know if you know the company. It's a company called Bayer.
Yes, I'm familiar with Bayer. Yes.
Yeah, and they made that horrendous acquisition of Monsanto all those years ago, which is coming back to bite them. And this week they've been ordered to pay 1.5 billion
Yes.
to 4 plaintiffs. That's 1.5 billion to 4 plaintiffs. I believe they have in the region of 165,000 people that want to claim off them. So if they're paying 1.5 billion to 4, I mean, we're talking trillions of dollars here.
Well, I think it needs to be seen if they're really going to pay 1.5 billion. I doubt it's going to be that high. Maybe I'm wrong, but I mean, in general, what the situation isn't that great for Bayer, right? I mean, they all have this litigation risk above their heads, and on top of this, they have some cyclical issues, right? So agriculture in general has been pretty weak this year. Farms in general, the supply chain had just too much product, so pricing and volumes are really biting them in the ass. And that's one of the issues. But I think if they get away with a scratch when it comes to these litigation issues, Bayer could be quite interesting, especially if they break up, right? So consumer health and even the agricultural business is quite interesting from a valuation standpoint. So I always said I'm actually monitoring them quite consistently because I would be interested in maybe buying the spin-off, the agriculture spin-off. Well, it needs to be seen, what happens. But if they cut costs, slim down management, just streamline the whole company, I think that could actually bear fruit. And the valuation is, I mean, they have priced in so much weakness, right? Bayer used to be Germany's biggest stock-listed company, and now I don't know where the market cap is, 30 billion or even lower. As I said, it's a high risk play, but I'm closely watching them, and maybe it could be my first European play in my portfolio in the next few quarters. But yeah, it needs to be seen what the litigation, what happens to them. And I think early 2024 they will present a plan to streamline the company, which could be quite interesting for shareholders and potential shareholders, I should add.
No, so I mean, for me, as long as this litigation is like an invisible hand above the company, I would not touch it myself. I mean, I own still shares in this in this stock, but I mean, they pay now, what is it, to 3 Gartners, 1.5 billion, because these people are horrible sick, yeah, but for me, it just tells you, like, so a life in New York is worth 500 million. In Europe, they don't even have cases and litigation, so it also tells you what kind of our lives are worth here, from that point of view. But it's crazy, right? They settled already for 10 billion before, yeah, with but for only for a limited scope. Then also they tried to via the court ruling to how is it decline any potential lawsuit. They lost that as well. So this is just a major invisible hand, and as long as it's above this stock, and you get these litigation cases of 500 million, and there's still 165,000 outstanding, yeah, then that I guess the market could see it, or the bearish people would see it as a bankruptcy filing if they really if they are not able to settle it, yeah. And that's the question, because that seems to be the biggest issue, to settle it in the States.
Yeah, I mean, there are multiple ways to avoid such a risk. I think
but they have not been able to do that, because
no,
this is
so
already
far
for
not.
2-3
I mean, Johnson
years.
Johnson
Yeah,
also, I mean, they have some claims related to baby powder, and I think they tried to bundle all these claims in a separate company and just file for bankruptcy, which was denied by a court. So I mean, it's obviously an uphill battle. It's court rulings. It's really hard for me to comment on this, but I don't think it's going to be as bad as people expect. And on the flip side, I mean, if this works out, right? I mean, Monsanto and Corteva, they essentially own the seed supply chain. If they somehow manage to avoid the worst of the worst when it comes to litigation, they actually have fantastic assets. From a wide mode, if you say this company, I mean, competition is always a risk, but yes, the acquisition of Monsanto was a bad idea in hindsight, but some of the assets that they bought really allowed them to own big parts of the agriculture supply chain, really at the start. And I think those assets are just absolutely fantastic. Now, obviously, these court holdings are a big risk, but if they manage to somewhat limit the damage, then Bayer could be a very interesting play.
Yeah, it's just too much unknowns when you've got litigation of that size and magnitude. It's too
Yes,
many.
exactly. It's really hard to assess how bad could it be. Especially, I'm not a lawyer, and I read articles. I can somewhat make up my mind, but as you just said, figuring out how bad could it become, it's somewhere between not that bad and bankruptcy. But yeah,
I've been in the stock since 80 euros. Yeah, it's now 34 euro. And at 60 euro, we fall like 10 billion, maybe a little bit more. It can't get worse. It can't get worse. And the opposite is every time true. It only gets worse. So and by the way, on the flip side, to your point about the assets, this week I believe the European Commission also voted in favor of using glyphosate and such as well.
Yes.
Because they want to put a European ban on it, and it's not happening. So at least it protects the market for these products in this case. So they've been lobbying well.
Yeah.
So if they can lobby as well in the States as well for these court rulings, then I could maybe start to become a little bit happy again with owning Bayer.
Yeah, I mean, lobbying in court rulings is a bit different, but I think I don't think the EU really had an alternative. And I could be wrong, but I watched the stock on the day of the court ruling, and I don't think it was up by 1% or something. It was just almost neglectable.
Yeah.
So I think that was just expected because the EU bias is so dominant, and these products. I mean, it's really. How dangerous is glyphosate for our health, right? I mean, I don't know. If you Google, you will find all kinds of opinions, but I think it will take some time until there are alternatives that are, let's just say, better for the environment. But I think obviously there was some good news among a wave of bad news for Bayer. So we will see where Bayer goes.
Yeah.
Awesome. Okay, the next section we usually do what we call a rapid fire round. It's really just sometimes to loosen our guests up and to have a little bit of fun and to see. So European DJI will ask you 5 questions. It'll be A or B. Without thinking, you have to give your answer. And then at the end of the 5 questions, you can clarify one if you want. So we see how this goes.
Okay, let's go.
We'll keep it nice. So the first one is an easy one. Walgreens or CVS?
Walgreens.
Good. A frugal but poorly dressed partner or a partner that dresses really nice but puts your budget continuously under pressure?
Let's go with frugal.
Being one day Elon Musk or Henry Ford?
Musk.
Okay. Realty income versus Vici?
Vici.
Good. And then the last one, 100,000 annual income until retirement or 35,000 annually on social welfare until retirement?
Wait, what was the first one? 100K for
100K while you're working, and the other one is 35K annually without working.
Can I still work on the side if I get it, or do I really?
No, you will be sitting on your fence outside, opening beers and
then
throwing
I
the
take down
caps
100.
For the 100, yeah.
Yes.
Good. Anything you would like to clarify?
Well, I really hated this question: Walgreens or CVS. I think it was last week. I did an article with Brad, and we said, basically, Walgreens, they have growth potential. I mean, sure. I mean, the odds are they will cut the dividend. Who knows? But you want to own Realty. I mean, Realty Income in this case, which is one of the biggest landlords of Walgreens. So I would own their real estate, not the stock itself. But yeah, I think of the two, Walgreens is probably the way to go.
Yeah. Thanks. So then, thanks for answering these questions. I guess then it's a little bit time now to learn something more about you and your investing journey, Leo. So how did you get started ever in life with investing?
Well, I got started roughly 13 years ago when I said correctly? Yeah, when I was 15. I'm not entirely sure how I started. I think it was because I read something about which was called Daimler back then. It's now Mercedes. And I thought, well, stock listed car company, and I thought, let's just look into them, see if they're interesting. And from day one, I really thought I knew how to invest. So, and I remember telling my friends in the first week when I really found out about investing, I said, you can make like 1.5, because on the day when I found Daimler back, Mercedes, they were up 1.5%, and I figured out if they go up 1.5% every day, and I could make some like a pretty penny. But I was 15, and it just evolved from there. I tried all kinds of. We're talking a few hundreds in the beginning, euros, and then a few thousand. I started, I tried day trading. I tried investing in biotech penny stocks. I even use leverage products like in Dutch, if the ING turbos and sprinters and all these things. And then at some point, I think when I was a few years later, 18, 19, I started to get serious about investing. I had some great mentors in my life who really helped me to see what investing is all about, what to look for when doing research, especially what I like to call big picture, macro research, to really understand what moves a company. But moves a stock, I should say. And when I was 18, 19, and it got way more professional. And yeah, doing my studies, I focused a lot on investing. Essentially, since I was 16, I've monitored markets every single day. And when it got more professional, I actually helped people manage their portfolios. I did, we tried different hedging strategies. We went long certain stocks, short other stocks. And then, when I was close to graduating college, I did an internship at Henkel's Treasury as well. After that, I went back to get my master's degree in international business with a focus on supply chains. So that had always been my thing, the bigger picture, understanding supply chains. And before I graduated, I started working for a company that advised a high net worth client and hedge funds, and that really helped me to understand this industry. And we did special projects. And on the side, I continued to grow my Seeking Alpha account, where I just really decided to focus more on dividend/dividend growth, which I really started to focus on. I think it was 2019, 2020, when I invested, when I started to make more money. So I really had more cash to invest, and I decided to invest everything in my long-term account. So I think since 2020, that's when I started the dividend portfolio that I have now. I did dividend research way before that, but since 2020, I've almost every penny that I make invested in dividend growth stocks. And as I said, on the side, I do Seeking Alpha. I work with Brett on white modes, on iRead, and we advise high net worth clients with another company. So yeah, that's pretty much how it started. Really, just trying everything out and just finding my way and really developing a strategy that works for me.
So 15 is incredibly young to start.
Yeah, and it wasn't a lot of money. I think the first stock that I bought, I'm not entirely sure because there are two companies that I believe could be my first stocks, but I think the first one was Deutsche Bank. Back then was the Euro crisis, and I figured, every time when European finance ministers met, banking stocks went up. So I thought, let's just buy Deutsche Bank for the next meeting. And I think I invested 100 euros in it, and because so much. And I talked to my parents about, I really want to invest in the stock market. And said, do you know the risk? And I said, yeah, absolutely. I know everything there is to know about investing because I Googled it. But I think it started with Deutsche Bank, and
Yeah.
I mean, I lost some money on it, and it just kept building on these experiences.
Did your parents invest? Because I mean, I don't know any 15-year-old that wakes up starting to want to invest. So there must have been some inspiration close to you, or
No, my parents didn't invest at the time. Most of my family in general didn't. I think it was just reading online, and I was always interested in politics, and I think one thing led to the other. If you just monitor markets, and I think I just slid right into it.
Yeah.
And Mercedes, one of the first companies that I watched. I was really a car guy. I knew everything there was to know about cars. I knew every model on the market, and so I researched these car companies a lot. And I think it started there because I mean these companies they have public filings, so I think I was looking up some stuff on Mercedes back then, on Daimler, and that's how it started. But in general, I didn't have lots of close role models, so to say. No, at least not in finance.
So what I'm interested in, because you said you did penny stocks,
Yes.
day trading, and then in 2020 you start dividend growth investing, and literally half a year later it's like everything to the moon, GameStop and everything. How are you able to control your emotions then and really sticking to the dividends?
I mean,
That's been hard for many investors during that time, right? We saw dividend investors suddenly turning into growth investors.
yes. And that's a great point. I mean, my day trading years, I mean, it wasn't even that long. They ended way before COVID, but I actually didn't have a hard time doing code. It was surprisingly easy for me because I really decided for myself which strategy I wanted to follow.
Mhm.
And I was really able to stick to. I mean, I have to admit, in 2020, after and when things went south, I invested a lot in energy, in industrial companies, just companies that were really beaten down, but
Yeah.
they offered a lot of value, right? But in I don't know 6, 7, 8 months that followed, these didn't do that well. I mean, they recovered obviously after the pandemic sell off, but tech stocks that really that was the place to be, and I did feel, I wouldn't say foolish, but I felt like I wasn't part of the party. Everyone was having fun but me. NFTs and all this stuff.
Yeah.
But things quickly changed because my thesis, even from 2020, and that's why I always incorporate macroeconomics into my decisions. I expected, you will get this demand rebound after pandemic. Everyone is reopening except for China, and this will cause inflation to surge. And you have this energy component as well, because energy companies, in this case oil and gas companies, they didn't produce as much as they used to, and production growth rates were actually quite poor. So I figured, inflation is going to come back, and it's going to force central banks to hike rates. And in early 2021, I think it was even January 1st or January 2nd when the market opened, that this rotation started. So you saw this
Mhm.
big prolonged decline in growth stocks, like ARK, Katie Wood's ARK
Yeah.
funds. And I mean, Apple and Microsoft are also growth stocks, but it's just different. But they came back, they're back at all-time highs. But all these ultra growth speculation stocks, whether it's hydrogen, what's a company, space something, Galaxy Space or whatever, Richard Branson's Virgin Galactic or whatever.
Galactic, yeah.
All these companies, so that everyone was bidding to the moon, they come down crashing like 80-90%.
Yeah.
And during that time, my stocks did actually very well. My energy stocks they almost doubled. Some of them even doubled. And you had all these value stocks that I had bought, they really came back and really were fueled by this rotation. So since going back to 2020, I have outperformed the market. The outperformance has gotten a bit slimmer because of the recent, at least this year's return of growth stocks. But in general, I'm very happy with my strategy, and I really figured from the start, this is the strategy you are going with. So ignore all the noise. And to this day, I really ignore hyped companies, and that was one of the things that that I taught myself in my first years, because when I started investing, I always bought hyped stocks, right? Because it just felt good because everyone was buying them and everyone had good reasons. And I was 17, 18 at the time, and it just, I get the appeal, right, of buying hyped stocks because you think you're doing the right thing because everyone agrees with you, but
You get confirmation continuously.
confirmation bias, exactly. And so that was one of the things that really taught me a lot. And I haven't had any struggles in the past few years with, of course, I have temporary underperformance, but I know that my strategy, buying dividend growth companies, will bear fruit over time, and empirical evidence, it proves this. And so I'm really happy with my strategy to focus on a hybrid between growth and value.
And do you see this as a long-term strategy, or are you constantly checking the macroeconomics and that environment and ready to pivot at any time, or are you now going to say I'm dividend growth and that's the strategy I'm following for, I don't know, 20 years or so?
Yeah, so I mean, the basic of my strategy is to buy dividend growth stocks, and I say dividend growth is always in parentheses because I buy some stocks that are not necessarily dividend growth stocks, like energy companies. But that's my core strategy, to just buy great companies at prices that I think are undervalued. So, but to come back to macro, I incorporate macroeconomics in almost every decision. So in a certain environment, I look, what do I expect from the market in the next few quarters? And where should I add, right? But for example, right now I'm interested in beating down energy stocks. I buy some real estate companies, but we can get into depth to that later. But what I don't do is I don't sell stocks. So if I decide that a company is right for me, I currently have 20 stocks in my dividend growth portfolio. I keep them. So when I bought cyclical stocks like railroads, for example, or Caterpillar in 2020, I knew I was getting a good price, which turned out to be true. But I also knew that I was going to experience multiple economic downswings in the future, right? So, I mean, God willing, if I get to invest for another, I don't know, 40, 50 years, I hope 50, more than 40, but I know I'm going to experience a lot of down cycles in the economy. So I only buy companies that I know that will withstand these down cycles, because I'm not going, at least I'm very, very, very unlikely to sell them in down cycles. I mainly incorporate macro into my buying decisions, mainly to just avoid, as we, at the start of this podcast, we talked about, a lost decade. I'm really thinking about this lost decade. In this scenario, I'm very, very unlikely to buy growth stock. For example, I wouldn't buy Apple at these levels, to give you an example. So that's how I incorporate macroeconomics into my strategy, which is mainly based on buying undervalued dividend growth stocks, if that makes sense.
Yeah, my experience is also, because I do this since 2014, is that every stock comes one time into value zone in let's say 5-6 years. There's always somewhere ahead when not every company has a streak that is just all the time continuing. So I have quite some Apple, because I don't know, in 2017 or 2016 the iPhone was dead. That was the whole narrative. Nobody who wants still an iPhone, right? So it was trading at a 13 multiple at the time. And I mean, it was amazing. And then after I bought it, Buffett started buying it, and then everyone started to say again, "Oh wait, no, iPhone is great because he had a nice story about it."
Yeah, exactly. And I think even I don't know if it was 2016. I think Carl Icahn got involved, and I think he tweeted he had dinner with Tim Cook to talk about stock buybacks. And I think, I don't know exactly when Apple started to buy back stock.
Yeah, but it was also around that time. Yeah.
Yes,
Yeah.
I think that, I mean, I didn't buy Apple back then. I mean, but yeah, as you said, I think understanding a company is very important. So that's also, for example, macroeconomics, again, higher rates, right? Okay, rates have risen quite consistently since last year. So what happened? Real estate investment trusts went down, even the solid ones like Realty income. So it's always, and that's what I tell people. If you don't really, I mean, you don't have to be a macro genius. I'm far from a macro genius, very far. But if you don't really understand what moves the stock, then you should always stick to ETFs, right? Because as you said, you knew why Apple was down, and you knew what you were getting into when you bought it, and that's what I incorporate into every decision. I know that my railroads are down 20 to 30% because of the downswing in manufacturing demands, right? And in related, I own one railroad with a lot of intermodal demand, which means it's highly tied to the consumer. And so I knew when the Michigan consumer confidence started to implode that it would have a material impact on that railroad, which happened.
Yeah.
I didn't sell it because it's a long-term investment, but I did buy more when it was really cheap. So that's how I think. It's just all about buying decision and what to expect. And also, that's what I tell people. You really need to understand the companies that you buy. And I don't mean knowing the name of every board member when they went to school and how many employees they have and all that stuff. It's just about what moves the stock, right? We all know the factors that move the stock market, like liquidity and all these things, but what moves the stocks that you own? Because the differences between stocks are so huge. I mean, you have growth stocks that absolutely fly when inflation comes down, and even growth. You have dividend stocks like Altria, cigarette companies that only do well when people rush into safe haven stocks that come with a yield. Then you have cyclical stocks in energy that performed horribly until the first year after the pandemic. So all these factors are quite complex, and it's not always easy for people to understand what
But that's where I like always to think about Peter Lynch, right? Buy products or buy companies, stocks of companies from which you at least have a bit of affinity with their products. That makes it also for me sometimes harder to think about US stocks like Walgreens or CVS. I just don't understand why, and also Home Depot, I don't own it because I don't understand how this works. If you think about Europe, this is totally different here. When you look at you have a few like Hornbach and such, Castorama, but still it feels like the culture around it of home improvement looks totally different. I mean, for God's sake, we build houses here with cement and bricks, like here in Poland, probably a half meter thick walls sometimes. Well, okay, let's say 30 centimeter, and there often when you look at these programs, it's just some wood, with
yes,
some
that's absolutely true. I think that there were two sides to that. I mean, people in general say don't get married to the stock that you own. Well, I mean, that ship has sailed for me, but I'm not naive, right? I mean, I love every investment that I have. I think absolutely fantastic companies, but I would still sell them if something were to happen, right? But I think you should invest in companies that you are passionate about, but not for the wrong reasons. I mean, a lot of people bought stocks like this drone manufacturer, GoPro, and they make good drones. These camera producers, they bought GoPro because they think it's a cool brand, which didn't work out for them. And so
this bike company, how was it called again? That you could bike from home?
They
give you a tablet with it.
Yeah, exactly. They glue a tablet to a stationary bike.
Yeah.
Peloton.
Yeah, Peloton.
Yeah, exactly. So I think I think it's I mean there's a flip side to this. People. Okay, I mean I need to go one step back. In general, I tell people who are not that experienced with stocks, buy an ETF, right? Because most people who are not that experienced would be much better off just owning an ETF. And if let's say you have 100 grand, okay, let's just invest. What do I care? 90 grand in an ETF and 10 grand in stocks that you're passionate about. If you fail, you have an expensive lesson, but you didn't ruin your financial future. But when it comes to investing what you're passionate about, I would say combine passion with knowledge. I mean, invest in industries that you understand. Because if you decide for yourself to hold stocks for a few decades, you're going through a few cycles that you.
Yeah.
So your stock is probably going to tank 20, 30, 40% at some point. And
you should know a bit of accounting, basic accounting, and these kinds of things to read a balance sheet.
Yes,
to understand a bit what a catalyst is for a company and such. We often say on the show, like, you can't borrow conviction. It's nice when the price goes up, but your investment thesis gets tested when the price goes down. and that's where you really need to have strong conviction about your buy decision.
And I really see this in my own portfolio. I mean, in 2020, 2021, when everything was just going up every day, it was just an easy ride. But when things started to go south, I mean, I obviously didn't panic, but that's really, you spend more time thinking about how safe are the investment that I have. What if rates remain elevated for 4 or 5 more years? How safe are their balance sheets? And as you said, you don't need to be an accountant genius. As I said, I'm far from an accounting genius, but people need to understand, what happens if your company has a 4 times leverage ratio or 5 times. If it pays 8% on its debt. The other day I looked into a real estate company, and the balance sheet was just horrible. I think they may go out of business, and at least if rates are elevated. And most people might miss this. And I think that's one of the biggest risks. So people should have some basic knowledge and really understand the industry that they invest in and the company. Because in Europe, if you buy, for example, BMW cars, this stock has done pretty well on a total return basis, but it had some very steep sell-offs, and most of these happen during recessions when people don't buy cars. And if you understand that the company is financially healthy and will bounce back because it sells cars that are more luxurious than just average consumer car, you'll be fine in the end. And I think that's very important.
And Leo, you mentioned earlier about ETFs, right? Something we struggle with is finding ETFs, UCITS, available to the retail investors with a dividend growth profile, because most dividend ETFs that exist, when you analyze them, they had flat dividends for years, unreliable, not nicely growing. And if you get, let's say, the Vanguard equivalent, it's like 1.4% or something like that. So what is your perspective on ETFs being, let's say, in the Netherlands or Germany, and then thinking about, dividend growth investment as a practice or as an investment style?
Yeah, actually, one of the things is the selection of dividends in Europe is obviously, as you said, quite limited. And also, I think most ETFs have elevated expense ratios. I mean, in the US, I can buy VU or SPY or even VIG, the dividend growth ETF from Vanguard. I can buy it, I think, 4 or 5 or even lower basis points expense ratio, right? So that's almost neglectable.
But SCHD from Schwab, we can't buy here unless we do some complicated tricks by option selling.
Is a fantastic example. It's a fantastic ETF, and I would, I once wrote an article on, this is again in the US, but just 50% SCHD and 50% S&P 500 or 50% dividend growth or just pure growth. But in Europe, it's a bit different. I mean, in general, people who I advise in Europe, they mainly stick to S&P 500 ETFs, or even the Vanguard Global ETF, All World. And there is an ETF which focuses on, it's not close to SCHD, but it owns, I think it's iShares US dividends. I don't know if it has growth in its name, but it owns Home Depot, it owns Walmart, all these names that SCHD owns as well. And that's an ETF that it has a 25 basis points expense ratio, which is, I mean, my limit. I wouldn't go higher than that, but it's one of the best dividend growth ETFs in Europe. And beyond this, I mean, if you really want to go high yields like SCHD, at least I haven't found a very good ETF in Europe. I think
not with a dividend growth component.
But I'm not sure.
Yeah, Van Eck is decent, but then if you look at the total return, if you would look at that, then nothing really shows up. And then I'm with you. You could better probably say, let's take the S&P 500, because I believe, I don't know, that in 2 decades from now, the US will be still strong, still growing, generally faster than other economies in the world. So they should also therefore grow the index, right, above average.
Yeah, and I mean, if you look at S&P 500, I mean, they are now heavy in in FANG stocks. But in general, these are also the dividend growth stocks that, I mean, the companies that grow their dividend. So yeah, I mean, S&P 500 or the all world ETF, these are always, the way to go for European investors. But as you said, you really need to be careful when you go for higher yields. I know that I'm not sure if it's iShares or what the ticker is. I mean, it's a long time ago since I looked into it, but it has a yield of like 4 or 5%. And if you look into its top holdings, it's all banks, insurance companies, and these companies, as you mentioned, the total return is just very, very poor, and that's a horrible way to get high yield exposure. So
and the
that's
dividends get often cut there in the ETF, so you see this
dividend
as
cuts as
well.
well. And then you have regulatory stuff. I mean, I wouldn't buy banks in Europe. I think one of the biggest issues in Europe is still breakup risk. I mean, it's a while ago since we had the euro crisis, right? But political risk and these breakup risks are still very, very much elevated. So I'm not a huge fan of investing with these tail risks, right? But that's just personal. I mean, I don't want to keep anyone from investing in Europe. Just know what the risks are and just be careful where you put your money.
So where do you see the best opportunities right now? So
Right now, yeah, I actually had a tweet. I said earlier in this book, I have a pinned tweet on my Twitter where I said, I mean, in a scenario where I think inflation could be sticky on a prolonged basis. I mean, even if you get a recession, inflation would come down, obviously, but I think inflation could rebound rather quickly when economic demand rebounds as well. You have, I mean, energy companies aren't producing, at least aren't growing their output as much as they used to. They're focusing on free cash flow instead of production growth. You have labor shortages that are really persistent in certain areas. Supply chain reconfigurations from China away from, not entirely away from China, but you see that companies are bringing back production that's inflationary. So I think in general, inflation could remain elevated on a prolonged basis. And when you're dealing with, lofty valuations in S&P 500, and I mean, as I said, Europe is different story, but the risks are also different. I stick in my personal account. I buy energy companies, for example, Canadian natural resources. I really like companies that produce loads of free cash flow when energy prices are elevated. I also think the total return in general for energy companies will be very good in the next 10 years. I'm buying undervalued cyclical stocks right now because we are still in a downturn. I'm not saying this is the end of the downturn, but because we have been in a prolonged economic downturn, some cyclical stocks like Caterpillar, although Caterpillar, I would like it to fall a bit lower. Railroads that I own, they have come down 20-30%, and I'm buying these companies. I also invest in defense companies. In this case, not defensive, but defense and aerospace. I think not necessarily because I expect multiple wars in the future, but I think these companies they have good pricing power because of government contracts. They have anti-cyclical demand because it's just the biggest risk are supply risk, which is why some of them are still so cheap. So I'm buying defense companies. Actually, in my top 5, I own 4 defense companies, which is that's how much I invested in them in the past few quarters. I think high yield investments in general are interesting, but investors need to be careful. I'm not saying just high yield in general. There's so much trash on the market when it comes to high yield. But if you, Howard Marks, wrote a memo. He said we are witnessing a sea change, and that's basically my thesis as well. Just elevated inflation and rates will be higher for long, and in that scenario, you want income stocks. And I think he made the case that people should buy high yield bonds. Now, I'm not a bond investor. I like equity, but I think higher yielding companies are a way to go, which is why I like certain real estate companies. I like extra space storage, for example, in real estate, public storage, certain industrial REITs I want to buy if they drop another 10-15%. But I think in general, in the next 10 years, a big part of the total return will come from dividends. Right? I mean, I don't have the number at the top of my head, but in the past 10 years, the total return that came from dividends was rather low because you had low inflation. Everyone was piling into.
I think something like 20% only.
Yeah. But I think in the next 10 years, a much bigger part of the total return is going to come from dividends. I may be wrong. And even that's always where I always say, I will never rely on a thesis that could prove costly as I'm wrong. So I would never say like, okay, I'm bearish the market, I will go all in on cash. If I'm wrong, I'm going to miss like a few years of valuable gain. So I will never put myself in a position where if I'm wrong, I lose a lot. So even if I'm wrong, let's say we go back to a normal situation pre-pandemic, tech stocks do well, value stocks do moderately well. I will probably, well, actually, the stocks that I own now, they outperformed the market in the past 10 years as well. So I think, in general, I'm playing it safe. But I would, compared to 10 years ago, I probably own more energy, more high yield, and even just to be safe, own some beaten down growth stocks. In this case, defining growth is a bit tricky, but I like, for example, DHR is a ticker, Danaher in healthcare, Thermo Fisher. These companies, I consider them growth stocks. They're not typical growth stocks. They're not, high tech. Although I think they're high tech in the areas that they service. These companies are really interesting to me. I think if inflation is indeed persistent, they may underperform, but these are still the companies that I want to add on great prices, because I think in the next few decades they will do very, very well. So that's essentially what I wrote down for myself. So for listeners, energy, undervalued cyclicals, defense companies, high yield, beaten down growth, like healthcare.
Yeah, when you say energy, so I own my largest position is Shell. I bought a lot in 2020 when it was down, but also in the aftermath of the oil crisis in 2016. But I always feel like I buy oil, as an example, really when it's every day in the news. When CNBC has the whole day oil in the news and is talking the whole day about the oil price, I know it's time to look into oil stocks. Usually when this is not happening, it means that the price is elevated, there's some stress in the market, and those are good times, to be in Shell because of the cash flow. But if you want to get like the undervaluation, that's usually, for me, over the last 9 years, has been the signal that, okay, now is the time to really look closely at those.
I mean, I cannot disagree with you, because I think obviously these energy companies, they were beaten down quite a few times, and that's when you want to go really big into energy, right? So 2020 for a client, for a high net worth client and his fund, we went really big into agriculture, which is highly correlated to energy. But there was a difference. I mean, I bought most of my energy in 2020, so I'm set when it comes to getting the biggest gains already. But it's different. Energy is not in the same situation as it was 10 years ago. 2015 happened because of the US shale revolution. These companies were producing so much oil, and they were all
energy independence.
Exactly, energy. And when Trump came into office, it was it started again. I mean, they really started to heat up things in 2014, and that's when demand started to weaken, global manufacturing crisis, oil started to plummet, and some companies went bankrupt. But in order to repair their balance sheets, all companies decided to produce even more. So after this oil crash, oil production exploded again, and when COVID hit, oil went negative. That was just the front month went negative, but that's how bad it got, right? So, but now there's a different situation. These companies are saying there are two reasons. I mean, companies are saying we need to be more careful with our free cash flow because of the many headwinds, like governments, activists. They all want energy companies to produce less for environmental reasons. And then you have inventory depletion, right? So the shale revolution is really coming to an end. So these companies, they are running out.
And companies have been underinvesting. Yeah, they've highly slashed their capex. So
yes, capex is severely subdued. I think they need trillions to actually get back to actually get to a level where they can service future demand. But as I said, some of these companies are now running out of tier 1 inventories in major shale basins. So that's one of the reasons why they are emphasizing free cash flow growth over production growth. So, but obviously, I mean, if the economy gets really, really bad, you could still see $50 oil and much lower oil equities.
Yeah.
But I think the situation has changed, that OPEC has regained pricing power. So OPEC they are now protecting $80 Brent is what people say that they
Yeah.
are really looking for to protect. Obviously, we could go to 70, maybe 65, but I think everything in the low 70s or even mid 70s is where I would gradually add to my energy investments. But
Yeah.
but obviously, if you really want to go big into energy, I mean, we could easily see 10 very, very strong years for energy. But we won't likely see the opportunities that you had with Shell in 2016.
No, and you make a very good point there. So in my opinion, my thoughts about energy, I'm long-term bullish. I think that the whole, how you said, the ESG narrative, I think that you also slightly referred to, right, when you said activists and such, in this sense, has always been talking about peak oil. Peak oil has been shifting a lot as well. And for me, it's really clear. Look, they have been underinvesting in the industry. The reserve levels have been actually slightly declining with the big five over the last several years. So at a certain moment, they will need to, I would say, start investing again. But at that moment, I think oil will be also much more expensive here, because the investment case also needs to be there. And if you look at inflation and what it costs to how you say it, to find oil and to also then build everything, these are 7-8 years long projects. So you need to start yesterday to be able to get it in 8 years from now, right?
Yes.
So there's like, to your point, there's a really nice setup. But for me, someone who's already like having the biggest allocation to energy in the portfolio, I don't need more. I just reinvest the dividends. But if I would be like a starter now, I will probably nibble in here and there. The yields are decent enough, and the dividends are safe at the moment. Yeah, at least for the foreseeable future.
Yeah, I think what you say, nibble. That's in general what I tell people when, I mean, obviously we're at this tricky point in the cycle where the stock market in general isn't trading at a great valuation. So even if you find a stock that has great value, and the market goes south like 10-50%, you will probably lose money on that one, at least temporarily. So that's why I tell people just buy gradually, right? If you just buy a small position and add over time, if the stock drops, I mean, you can average down, which is a great strategy for long-term investors. For trading, probably not so much. That's not who we are targeting. And if it goes up all of a sudden, you have a foot in the door. So in general, in market situations like the one that we are witnessing now, I really prefer to just buy gradually and just build positions slowly.
Yeah. Cool. It's almost been an hour. It's been we could probably talk for at least another hour more, but we might finish up with one last question. And for me, that is, what has been your biggest or your main learnings, I suppose, over your investing journey?
I think the most important thing what I have learned is to focus on long-term investing. I think in general, I mean, I trade a little bit, but just on the side. But I've almost every penny invested in long-term investments. So focus on great companies, buy them at great valuation, and just don't worry too much about it. I think people overthink everything, and not just retail investors, but it happens among professionals as well. Everyone is freaking out when there is a new interest rate decision. Everyone wants to exactly predict the rate cycle. Everyone wants to predict inflation correctly. There is absolutely no need to do this. I mean, people who make millions every year have some of the most horrible predictions, and yet they still make good money, right? So I think, just focus on what works. In my case, that's long-term investing. I mean, last time I day traded this, I don't even remember, so long ago. Focus on what works, stick to great companies, and avoid the noise. Just look at the big picture, and that's really what taught me well and why I sleep so well.
Well, Leo, talking about sleeping well, I should just mention with your investment strategy, we actually got a question from one of our listeners called Tadeusz. So maybe let's go to the lessons questions with this also straight away. And he's actually asking, like, how many hours do you sleep on average? Because you're really like writing sometimes 2 or 3 articles a day on Seeking Alpha, if I saw it correctly. So yeah, we just had to ask this question, Leo, because this is like a production we've never really seen before.
Yeah, actually, it's two. Sometimes, I co-produce something with Brad, and I obviously have different work, on the side. So that's not all I do. So it's even more. But I sleep well. I think it's like it's probably 7 hours, 8 if I have a good night. But if I get 7 to 8 hours, I'm happy, and I get it most of the time, because I have a really clear schedule when I work. And the reason why why I'm able to produce so much is it's just planning, and I think focusing on companies that I understand, and just after a while you really get used to researching these companies. What am I looking for? What do people want to know? Because I mean, there's a big difference between doing an overview of a company, focusing on earnings, or just doing a deep dive for a $400 million investment, right, for special clients. So
Yeah.
I mean, these take weeks, but in general, it's just planning. It's all planning, and I do put in a lot of hours. I think I probably outwork most people, but it's just a passion. We'll see how long it lasts, but for now, I'm quite happy
I
with
hope
what I
still
do.
for 50 years, Leo.
Oh
at
yeah,
least.
I mean, Seeking
Yeah.
Alpha in this case, but it's yeah, I mean, and that's what I said. I think someone asked me, what would I do if I would make 10 million tomorrow? Well, I would probably still be doing what I'm doing now. So
Yeah.
I'm quite happy with how things are going.
Cool. And the same guy has asked a couple of more follow-up questions actually, and one of them is, what is your background? Is it economics, business school?
Yeah.
What?
So I don't know if I mentioned it earlier in the talk, but I have a background in well, I studied both a bachelor and a master's international business administration, and I do have a focus. I minored in aerospace management and operations, and I later did a focus doing my master's on supply chain with finance. So that's, I mean, I'm not the finance professional. I mean, you probably know from I'm not a typical analyst. I'm basically I'm an equity and macro strategist, as I said on LinkedIn. But it's I'm just a big picture guy. So I look for bigger trends, macroeconomics, supply chain developments, and just find investments that go with it. And as I said, I do have some background in finance, so I obviously do know how to read balance sheets and understand companies. It just I would say some of everything, and I just managed to combine it and turn it into valuable information for a wide variety of readers and interested parties.
Yeah. And then he's very interested in your allocations in your portfolio. So, for instance, how much energy, if you look at your portfolio versus undervalued cyclical, is this something you feel okay to disclose?
Yeah, I mean, I can obviously disclose my allocation. I think I covered it in a recent article. So I have my biggest sector in this case is industrials. I have more than 50% exposure to industrials, but in this case, I mean, industrials in general are cyclical, but 27% of my portfolio, which is roughly half of my industrial exposure, is aerospace and defense. So I have more than a quarter of my money in aerospace.
Yeah.
I have like 15% in freight and logistics, which is mainly railroads. I have 11% in real estate, in REITs, which I'm looking to boost. I have in my different portfolio 10% in oil and gas, but I do have in my trading portfolio energy exposure as well. So that's roughly, I don't know, half of the 10% I would add. And then it gets more moderate. I've like 6% in machinery, which is John Deere, at least Deere and Company and Caterpillar. Home builders, which is at least home building supplies, which is Home Depot, PepsiCo, and then it just really, I think the average size that comes after it's like 4%.
Yeah.
So it's I'm really what's interesting to people. 27% defense, 15% railroads, 10% REITs and oil each. So that's pretty much my biggest allocation.
Awesome.
Awesome. The next question is from Cohen, and he is also on Seeking Alpha. European DJ is laughing at me because I definitely pronounced that name wrong. But he's known on Seeking Alpha as the Dutch dividend therapist. And he's a follower of yours, a big admirer, and he's wondering, have you got any tips for a beginner on how to, I suppose, grow their Seeking Alpha account?
I mean, Seeking Alpha, growing Seeking Alpha has come way more difficult because, I started in 2015, I believe. So that's a long time ago. And then it was much easier to grow on Seeking Alpha. And one of the problems that Seeking Alpha has, like so many companies, is on one hand, competition is getting worse. Substack, social media in general, and everyone has just their own website with research. And then you have, in general, more people have started to contribute, right? So there were articles on everything, and it's really hard to find an edge. But if you want to grow an audience, then I would say focus on quality and on your expertise. And it sounds, I know it sounds so obvious, but it's really true. I have noticed people who gain the most followers and keep these followers on a long-term basis are really the people who stick to what works. In my case, I developed this into dividend growth with a macro edge. So I most of the time talk about macro and all these things, and that's really, I believe, this has given me an edge, right? So I think some people cover, I don't know, they only cover energy, some only cover healthcare, and that's fine. Just find out what works for you and really excel at what you do, because competition is fierce. And even if views are really bad at the beginning, you will grow into it. I mean, it took me, I don't know, I think it took me like 5 or 6 years until I had some decent views and a decent audience. And as I said, growing this is only becoming harder. So focus on what works for you, on your strengths. Develop this, and it will take time, but eventually you will figure out how to accelerate audience growth. And I use Twitter as well, and you will just build a more interactive audience, which is the most important thing. And I always say, if it wasn't for the comment section on Seeking Alpha, I would have left Seeking Alpha a long time ago. But I just think it's a fun experience for me as well, which is why I'm still doing it. And obviously on Seeking Alpha, I met Brad, and we are working on some great things. And just, as I said before this answer gets too long, just focus on what works for you. What are your qualities and strengths, and just really deliver top-notch research. Don't try to just compete on volume, but really try to compete on quality. It may be hard at the beginning, but it will really pay off. And especially with AI just around the corner, if you don't have an edge, you won't make it in I would say, third-party research.
Cool, good advice. Ronnie has asked us about the healthcare sector in general. He's increased his position in Roche, but how would you explain the current correction in the health sector?
How would I explain the correction in healthcare?
Yeah.
Well, it depends. I mean, I'm not familiar with Roche. I focus on different areas of healthcare, but in the past few quarters, actually, I've done a lot of research on biotech, healthcare suppliers like Danaher, but also produce of devices like Abbott, Dexcom, etc. So it's not really easy to say that there is one main driver behind healthcare weakness. I would say in companies like Danaher, so healthcare suppliers, and even companies like Abbott, they have suffered because of post-pandemic demand decline. Right, these companies did very, very well during the pandemic when demand for research tools and even just healthcare in general was very, very high, and so investors priced in a lot of growth. And now we are seeing, for example, Abbott, to name one company, they produce testing kits, and obviously these are not needed anymore. So they're seeing a pretty big decline in core revenue growth. That is not only a decline in growth, but actually contraction. So that's one of the reasons why investors aren't that keen on investing in these healthcare companies. And also you have these GLP-1s, these weight loss drugs. And people thought, with these weight loss drugs coming to market, there's a lot less demand for healthcare in general, because I think obesity is like a driver of many illnesses, like heart failure, cancer, blood pressure. I mean, you name it, all these things are just tied to obesity. And investors figured, if obesity is going away, which isn't happening, but just to say, if it becomes less, these companies will see deteriorating long-term growth opportunities, which hasn't turned out to be the case as I expected. But it was one major factor why some healthcare companies didn't perform so well. But in general, I think healthcare opportunities can be used. I'm buying Danaher, as I said. I like Abbott. I like a lot of the medical device producers. So, for example, ResMed, respiratory medicine. They produce breathing support, respiratory, as the name already said, support tools. And Dexcom, they produce insulin tools and all these things. I really like these companies. So I've actually been bullish on a lot of healthcare companies. And I think weakness is absolutely an opportunity in this sector.
Okay, cool. Nice answer. The next question is from BTO5, and it is from, he's asked us, Mr. Charlie says the first 100K is and he's crossed out the word there. But what is your opinion? When do you start feeling the rolling effect of compounding, I suppose?
Yeah, it's a tricky one. I think it's a personal thing, right? I mean, I think in general, if people just invest whatever they can, that's a good start. I mean, if you do €100 a month, for example, it will take a while until you make a difference, right? In 1 year, it's 1,200. After 10 years, it's 12 grand, just without interest in gains.
Yep.
So it will probably take 20 years until stock market fluctuations actually make a difference to you financially, at least to an extent where you can say, yes, I am protected against my job loss or whatever. But to me, when I had 20 grand, for example, I felt that it was a lot, right? Because 1% of 20 grand is €200. And back then, my job, I was bartending, didn't pay that well. So in comparison, it was a lot of money. But then you go to 50, to 100, 150, 200, etc. I think I stopped feeling a difference. I think when I crossed 100, I felt, okay, wow, this is really something. But everything since hasn't really made a difference to me, like at least emotionally. I mean, obviously, if you have 100 or 200 grand, that's a big difference financially, but not emotionally, at least not to me anymore. I just really like what I'm doing. And as I said, I wouldn't even care if it's 100 million or 1 billion. At some point, it just doesn't matter. And the most important thing for people to remember is just invest whatever you can, build something for yourself, and actually enjoy doing it. Because some people, I mean, if you invest every excess penny that you can spare until you are 70, well, I mean, odds are some of us don't make it to 70, right? And it would just be a waste. So just enjoy what you're doing, invest in great companies, and you will be fine. You will enjoy even the compounding effect with small amounts. So that's what I would tell people. Just don't fall for the comparison trap. There's always someone richer. There's always someone who gets more dividends, and especially don't focus on high yield dividends just because you want to make more dividends. So many beginners fall for this. They have like 10 grand to invest, and they're still young. They invest 10 grand and they invest it all in high yield stocks just because it pays them more dividends. But it's just, don't do it,
Right.
people. Just focus on growth stocks, depending on your age, and just enjoy what you're doing. You'll be fine.
Or even worse, they put the first money in TSLI and treat that as a dividend ETF.
Oh, yeah, isn't it the covered dividend, the covered core ETF from Tesla?
Yes, exactly.
Yeah,
and they see that as
Tesla or
dividend
something, yeah.
income then. And I think it's more speculation than long-term investing.
Absolutely. So that's why people shouldn't fall for this.
Yeah.
I don't know when compounding makes. I mean, if you have if your annual expenses are like at 10 grand, then you don't need to compound as much as people
No, true.
who have expenses a year of 100 grand. So I mean, just look for your own situation. Don't compare yourself to others, and just have fun. That's as easy as it gets and straightforward.
Awesome. And then the last question we have is around a company called Greencoat UK Wind. You spoke a lot about actually energy. What's your thoughts, before I ask the other question, what's your thoughts on renewable energy?
Well, I think, renewable energy is fine, but I know where this question is going. But in general, solar panels for certain houses make sense. But as a mass adoption of energy, it's not a solution. It's not a replacement for coal and oil. I think it's fine. It's a niche technology, because if you want to get independent from Russia when it comes to natural gas, you cannot become dependent on China for rare earths to produce solar. And I think wind energy is just ridiculous. I mean, if you look at how much metal goes into and concrete goes into one of these windmills, and they destroy the entire ecosystem in the North Sea and all this. I think nuclear energy is the way to go. I'm not really keen on renewables, especially from an investment point of view, because without subsidies, this entire industry is toast.
It's very low margin.
Extremely low margin. If you look at Siemens Wind and Energy, General Electric's division focusing on renewables is doing poorly. I do like. Even though I invest a lot in oil and gas, I'm not paid by the sector to say positive things about. Oh, I'm definitely in favor of reducing pollution.
Yeah.
But I think we need more efficient ways to achieve this.
Yeah. And I suppose that's why these are heavily subsidized at the moment, because
without subsidies, most of them will go bust.
Yeah. So that's there. But the question was, for me, it's about the charges that UKW charged. So they're a closed-end fund and managed, so the management fees of around 1.2%, which is not too bad for one of those funds. They pay a yield of around 6%, so you need to take that off. You're still getting around a 4% yield from them. So yeah, typically with closed-end funds, you would expect to pay roughly around a 1% management fee for these guys. You spoke a lot about ETFs earlier. In Ireland, ETFs are a bit of a pain. With tax, we got higher taxes. We also have this deemed disposal where you have to pretend to sell an ETF even though you don't sell it every 8 years, and then every subsequent year, and then pay capital gains on that. So ETFs are a pain, whereas closed-end funds give you access to some of the same markets. They also give you access to a lot of different markets out there as well, public, private sector, a lot of companies. So from an Irish perspective, they make a lot of sense. And for me, 1.2% is not too bad in terms of management fees for that.
Yeah, I think that makes sense for closed-end funds. I don't even know what ARC is, what KV Woods is charging for her ARC fund, but I think it's like 70 or 80 basis points. I'm not sure, but a lot of these active funds are actually quite expensive. So 1.2% for a decent closed-end fund is okay.
Yep. Okay, that's the last question. We might just finish up and ask you one more. And if you were to pick one stock, we normally do like a stock pick of the week. Just your favorite stock, what would it be?
And is this based on the short term? Is this the company that I believe has the most short term potential?
Yeah, it could be anything at all.
I actually thought about it because in my preparation, but I think if I had to buy something right now, I would probably buy. You know what? I would probably buy Deere & Company. Stock ticker DE, the producer of agriculture equipment.
Yeah.
That would probably be my go-to stock.
They have the best tractors in the world.
I would say so, yes.
So I have a family member who's, let's say, farmer, and when they see deer, they stop. They want to touch it.
I like these people. Deere was actually one it was one of my biggest investments, and I haven't bought too much of it recently, so it has shifted a little bit to the downside, to the smaller part of my portfolio. But I think Deal is a fascinating company, and they produce great tractors. They have great margins. Obviously, now with the manufacturing recession, they've been pressured, which, you know, it's now a stock that I think, I don't know exactly where they are trading right now, but I think on long term it's like a $600 stock. So that's, I think, 70 or 80% upside. At least that's what I think in the next few years.
Yeah.
Nice.
Good. Nice one. Leo, thanks a million for coming on the show. I have to say that hour that we were speaking flew by. We could have done quite a lot more. It's quite interesting take using macro and some of the factors that you use to make your decisions, which is, as you said, it gives you an edge on seeking alpha, but it is quite unique as well in our world. So it was actually quite enjoyable speaking to you.
Well, thank you very much for having me. I thought this was a fantastic talk. And yes, we could have gone on for a few more hours, but
Yeah.
I think yes, I'm very much looking forward to hearing the opinions of your listeners. And well, I mean, they can reach me on Twitter and Seeking Alpha and whatnot. So thank you very much for having me, guys. It was so much fun.
Thank you too, Leo, and we'll make sure that we put all the links in the description of this podcast to your Twitter profile, Seeking Alpha profile. Also, let us know after the show if there are other links that you would like us to add where people can find you. And yeah, hey, who knows? Maybe let's see you one time in the future again. I really enjoyed it. You're very insightful. You're a book of knowledge. So yeah, it was a pleasure having you on the show. Thanks,
Likewise.
Leo.
Thank you very much, guys.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.